Hello everyone. It's a pleasure being here. We've got a very amazing panel of founders within the fintech space, and fintech is very important because while it looks like something that's a side pocket, a lot of what's happening in the world today, especially with geopolitics, most of it is actually linked to fintech. And what these guys are investing in are the on ramps which link to the traditional economy and ultimately, the protocol layers, what you're seeing in the blockchain and cryptocurrency, and then the convergence of blockchain and AI eventually, which will happen in a lot of these platforms as well, is where when the economy moves to tokenization and digital assets. To me, this panel particularly is very important because they act as the interface in the current old world with that emerging new world. So, with that, I'll start off. I would favor my own portfolio. So, I'm going to start off with Arif and Fatin first. Please give a quick intro about yourself, your company, and then we can deep dive.
So my name's Arif. I run a small BNPL in Pakistan called Kiss Bazaar, which is a sort of product financing for the unbanked, for the mass Pakistani population. It's been now about 3.5 years. We're there in about 8 different cities and trying to um, empower the common person as much as possible for his basic needs, like a TV, a fridge, a phone, an air conditioner, etc. Thank you.
Is this on? Yeah. Hi. Hi, my name is Fatin, and I run a startup called Smartlane. It's a B2B SaaS platform, and we aim to optimize deliveries, operations, and finance for e commerce merchants. So essentially, financing e commerce merchants. Yeah, that's what.
Omer?
Hi, I'm Omer, founder and CEO of Postex. We're Pakistan's largest e-commerce service provider. We do financing for e-commerce platforms with embedded logistics.
Hi, my name's Aleena Nadeem, and I'm the founder of EduFy, which is short for Education Finance. And we do buy now, pay later, but for the education sector called Study Now, Pay Later, SNPL.
Assalamu alaikum. Omer bin Ah. I run a fintech called Hubble. We do B2B supply chain invoicing, payments, and financing for large corporate supply chains.
Okay, I guess I'll start off with the first question. Fatin, we'll go to you first. You're doing something, so Omar is doing something similar to yours. Can you explain to us your model? Because that model actually makes sense as well. So I'd love to get your take on why you chose the switch model and how you see it scaling in the region.
So essentially, like you said, Omer and I, me and my founders, we identified the same problem, right? So it's a very, very real problem, which is fulfillment and then finance for e-commerce merchants. So essentially, what happens is, so I've been in e-commerce for the last 10 to 12 years. I was running an agency where we were managing e-commerce operations for large brands in the country. And what we noticed was that no e-commerce merchant was working with one courier partner, right? When we started out in 2014, we just had two courier companies that were doing cash on delivery. And Pakistan is still 90% largely a cash on delivery market. And that was TCS and BlueX, right? And then today we have over 30 courier partners. And every e-commerce merchant works with a mix of 4 to 5 different courier partners. So what we decided to do was we decided to bring them all onto a singular dashboard, right? And now we tell the merchant that you don't have to go and manage relationships with different courier partners. So they integrate with Smartlane. We're integrated on the checkout. The order lands on our platform and we push it to the best performing courier on that delivery route. So in turn, what we feel, we're able to bring down their returns and cancellations because in a cash on delivery environment, every single day your order is delayed by, your cancellation rates rise. So that's number one. And then number two, because of cash on delivery, where they're always in a state of cash crunch. The people like Omer that are solving for that, which where they give instant payments. But the other courier companies do not have the bandwidth to do that. So the minute a courier goes to the warehouse, regardless of the company, upon dispatch, we credit 80% of the value of the goods into their account in real time and our wallet. So that's how we're different to Postex. So we act as an aggregator. Yeah.
And Omar, I'll let you kind of give your take on how you're solving this problem as well.
Yes. If we looked at the market in a different way, so we wanted to solve a bigger problem, which is inability to access capital for e-commerce platforms. And we wanted to start with cash on delivery financing because that was the biggest problem for them at that time. But we didn't want to solve the problem where we're financing, but we don't have the ability to get the cash back on time. So we had two options. Either we do a SaaS model where we're doing the financing and they let them use whichever logistics company they want to use. In this case, we are not really solving a problem, but we're just transferring the problem from them to us. And then we have a lot of dependency on these logistics players to settle us. So rather than having that gap of around 10, 15 days, we decided to do the logistics ourselves, which gives us control over the financing that we're doing, get the capital back on time within 2 to 3 days, and redeploy that capital. So that leads to more capital efficient way of financing the same merchant, solving the same problem, and then getting the data that can help us do growth capital for them.
But now, to be the devil, even though I'm invested in you, but I have to ask the question that when you've now expanded to Saudi and UAE, technically you validated their switch model, right? It's the whole, but I get it. So in Pakistan, the issue is trust, and you need to collateralize the package in order to actually then give debt against it to the merchant. So the value 70%. But in markets like the Gulf markets, there's more trust already with the consumer and the retail side. So I think both models have a place.
Yeah, and it depends on the market that you're solving this problem for. If you go back in Pakistan like 10 years or 5 years, the infrastructure for logistics was not there. And building a model on top of a infrastructure which is not very sophisticated or tech savvy, we would have had a lot of problems and dependencies on logistics companies. And we have seen that in the last 5 years, there are a lot of players who came in and who left the market. And in that case, that leads to massive defaults for us. So we didn't want to have any kind of dependency on those players. If you look at mature markets like Saudi or UAE, the infrastructure for logistics is there. There are players like Airmex, JNT, iMile, Samsa. So they have the infrastructure. You don't want to rebuild the infrastructure and spend the capital. You want to solve the problem that you thought about in the start, which is giving access to capital to e-commerce platforms, let it be in Pakistan or Saudi or UAE. So building on the top of that infrastructure makes it easier for us to finance the same merchant.
I just want to add something to that is, so like you said, we've seen courier companies come and go, right? But at the same time, what that's led to is teams that now were in that business. And we've seen a lot. It's a very, very fragmented market, right? So with fragmentation, what started happening is that we started seeing a lot of smaller couriers which were geography specific within the country, right? And then e-commerce merchants want to sort of use those because you get better delivery timelines, it's more optimal. And any market which is fragmented is very ripe for aggregation. So that's our view on it.
Okay, so now I'll come to the buy now, pay later. But we're gonna what I'll do is I'll start with Aleena because she's study now, pay later, and then we'll jump to you. And so Aleena, can you give me a bit of a synopsis on why study now, pay later, why it makes sense in Pakistan today? Now you're looking to expand regionally as well. I didn't think there was a capital shortage in places like Saudi Arabia, given that how much capital is floating in the Gulf region. So give me your thought process on what you're doing.
Yeah, for sure. So I think to just answer your second question first, there is definitely not a capital shortage in Saudi Arabia, but there's actually only 1% of the credit goes to the education sector in Saudi. And so in this education sector, there is a lot of capital that, we feel that we can inject. And the reason that I think both in Pakistan and Saudi, this product is very, not only imperative, but crucial, is because credit has the opportunity to change lives, right? And it has a multiplier effect. And when you put credit to work in a sector like education, that just like magnifies, right? So what we do in its core is if the fee bill is like $20,000 in Saudi Arabia, the average, you'd be surprised, like people don't have that, even in Saudi Arabia sitting around, right? And the fee size can even go to $50,000 in universities. So we break that into installments so that it becomes affordable. It's a form of short-term financing.
Sorry, and are you targeting expats that are living there in the middle income demographic or locals as well?
The locals only to start off with, yeah. So in Saudi Arabia, the education sector market is $17 billion. In Pakistan, it's $20 billion. And in Pakistan, there is no bank going after the education sector. So it's a completely untapped market. And that's where the space, fintechs can come in and go eat the spaces that the banks are not lending to. As you know, the banks are lending to the government. So we can come in and create our space, create a niche there, and really, really create a product niche there.
Amazing. So, Arif, I mean, to call you a startup, just like with Omer, it's very difficult because you guys are both seasoned. It's almost like you did the investors the honor of letting us in the respective companies. I would love to hear your journey in terms of thought process, because going to the consumer layer, I've, as an investor, always been scared of B2C startups, and you're one of the few exceptions where the NPLs have been curtailed. So I'd love to hear that thought.
Yeah, you see, Pakistan is a credit-starved economy, right? I mean, just like any other developing country. Um, an average person makes 1,000 rupees a day, so that's about 30,000 a month. An average fan today, a ceiling fan, which I think everybody should have one in Pakistan, is about 9,000 rupees. Can a person making 30,000 rupees afford even a ceiling fan? Can he go to Habib Bank or Mizan Bank and get that 30,000? He can't, right? So companies like us are the alternatives. And before us, the traditional Kisto wali company, the installment companies, have been there for years and years, right? And there are thousands of them out there. So, I mean, we just thought that we want to do the same thing in a regulated manner, be more respectable about it, uh, take the customers more seriously than a neighborhood store, and give them an experience, and maybe make a ladder for them. That today they bought a phone, maybe, or today they bought a fan. Tomorrow they can buy a fridge. Day after tomorrow they can buy a bike and go on. We feel that if you give them household essentials, your recovery or your NPL will be low. But if you start giving them frivolous things, for example, and I keep on giving this example, if you give a guy who's making 50,000 rupees an Apple iPhone and you expect him to pay you installment back, God bless you, right?
So look, in the developed markets, we've got Experian, and I mean, I think what you're doing is phenomenal. We've got Experian, FICO, so that's the consumer side rating agencies, right? So, and you've touched upon this, but I want to slightly deep dive into this, because I think I would love to learn how you're maintaining low NPLs. And again, you touched upon the fact that don't give it to him for a motorbike or an iPhone. Give it to the person for essentials, right? So what happens? I mean, what happens on default side?
Yeah. So, I mean, as you know, we were doing this offline for a couple of decades before we started the online and regulated part. Um, so, machine learning, we were just talking about it outside. Machine learning has been there for years and years, right? So, if my system sees that a particular area, a particular gully number in a particular area has good people living in there, if someone comes from there, I can score that person accordingly. I don't believe big time into utility bills and all that. I think a person can be paying all their bills, but they won't pay you any installment. I feel that. I know a lot of economies just go on utility bills, but there's way more available out there. We also work with the social guarantor aspect, and we are more about physical touch point as well. So in a lot of areas, or the most populous areas, we actually have physical outlets as well, where there is a person-to-person interaction. I don't think Pakistan is completely ready for an algo-based approval yet, at least at that level. Maybe the top 10%, 15% they are, but not at that level. And I mean, this is, I feel that if you give them something that they actually need, and if the whole household knows about it, you'll get the money back.
Amazing. I mean, you guys are pioneering our entire consumer side borrowing sector. So it's amazing. Omer, I think you have a mic. Okay. So you're doing something very different. It's more dealing on the B2B side. Um, let's give everyone a bit of a color on what you do and why you chose to go in this particular vertical. And just a quick synopsis.
So our sort of adoption approach comes from my background working with the federal tax agencies and looking at how the supply chains were functioning. One of the biggest challenges that any emerging economy has in terms of tax transparency is that invoicing and payment are very hard to correlate. And I thought that this is an area where I had some experience working with them, that we could somehow marry the two. That if you have invoice reconciled with payments, then that obviously feeds into better tax transparency. Using the same principle, at Hubble early stage, we said that we should integrate into corporate ERPs so that we get real-time transmission of invoice data, integrate with all the banks so that we should be able to do the debit and credit instructions ourselves, so that we're not relying on anyone else telling us that the payment actually happened. Because see, you could fake an invoice, you would not supply the goods, you can't fake a payment because that's a debit and credit event that we orchestrated. So when you correlate the two things, you have what is the perfect environment for a credit score. And I want to thank the central bank at this point in time, because they had the foresight to see how we were constructing this infrastructure, and they came up with this funding opportunity for us, where they told us that use the same sort of infrastructure to use for financing within the supply chain, especially MSMEs. That fed into our supply chain financing angle. So 7 years, we are now focused on supply chain entrenchment. What does that mean? That means that we integrate large corporate supply chains for invoicing, digital payments, and that feeds into financing. So that's the digital supply chain community that we try to enable sector by sector. So we're very heavy on FMCG wholesale. We then have almost half of the automobile sector, construction, pharmaceutical. So sector by sector, every year we think that, we have the big names, now let's go on to the next sector. And that's the top-down approach that we've been taking.
Look, so I think one of the other questions I'll ask everybody else is that, typically when I said to my investors, I like fintech, I want to invest in fintech, right? The biggest concern ends up being where you're going to get the credit lines, right? And I'm going to omit you from this one because you've managed it. But what I'll ask is each one of you, and I'll let whoever wants to start first. Where are you guys using your own equity to lend? Because I want the audience to get a flavor for this. Or are you getting third-party lines from different NBFCs? Where's the money coming from to lend?
Should I start?
Yeah, please.
Yeah. So over the last 2 years, so when Smartlane launched, it was the very end of the startup bubble in the country, right? So we only managed to raise about $800,000, and we had to sort of build out the product, grow, scale with that. So we didn't have the luxury to even think about using our own equity. So we had to get more creative with it. And what we did was we created a debt fund with another NBFC. The NBFC currently is Credit Book, and we created a structure where other people have come in then. So we've lent over $12 million up till today. And now we have Bank of Punjab and Parvaz in that fund as well. So that's the structure we've been using for lending, and it's worked out pretty well for us.
Yeah, so it's almost like a step-by-step process. You get another fintech with a higher risk appetite to take, because they have to deploy, obviously, they've raised, and then you get the bank gets comfortable leveraging, seeing what's happened in your NPLs. Arif, Omer, Aleena, whoever wants to give their flavor next.
Like you said, Faisal, that it's a step-by-step process. Initially, we started with our own equity, and then we started moving towards more sophisticated lines from different banks. And that is something that you have to work on really hard, because that is something we were not able to do for first 2-3 years. And then it starts very small, and then you start building that trust with them. And then over time, you can really tap into their balance sheet. But it's mostly relationship-based. What kind of a relationship you have as an entity with that bank? There are multiple banks out there which have a lot of capital, but they're not deploying. And then the markets that we are serving are untapped. This is something that is not part of their mandate, and they don't want to take that kind of risk. So we're trying to build a layer where we can enable the banks access the market which they cannot access on their own. And that takes time. That is going to take maybe another 2-3 years for them to be on the same page to understand that how lucrative these markets can be with very low NPLs.
In a way, you've been raising equity to continue to prove your loan book and show your NPLs to then go back to the banks eventually to say, look, now you can take a risk. Would that be correct? Given a lack of any existing credit scoring mechanism.
Yes, agreed. And that's how you show that there is a proof of concept, that many times you can move the dollars into your own system, and then what kind of yield you can generate, and how would that reflect in NPLs as well.
Arif, Aleena?
Sorry. We're a little blessed that we have a bank on our cap table, Bank Al-Falah is one of the owners. But has it helped? The honest answer is, and I can speak for all of these guys, other than maybe Omer, it's a big problem getting money from the bank. But that's not just us. If you study India closely too, um, the BNPL players, they're either deposit taking NBFCs or they're playing with their own equity. Banks just don't lend to this particular class of asset, right? And I don't understand why. But in Pakistan, it's very simple that they have the treasury bill option, right? They don't have an ADR issue anymore. They can just put as much money as they want in that. So the truth is that though we do have some lines from the bank that's on our cap table, yet the biggest part is coming out of our own equity, and I think it's going to continue like that for the foreseeable future because even though our NPLs are probably better than theirs, they still feel that it is an unlendable sector that we all, or most of us, are working with. Maybe not Aleena, because she works with students that come from good families as well, but most of us are probably working with the unlendable sector.
Omer, do you take? Or Aleena, sorry, Omer's already spoken.
No, I think look, everyone has already said it, but I think that we can get, we thought about in EduFy getting a little bit creative. We can offer FLDG, but you need a minimum loan book, right? Like you're not going to get any bank interested before like $2 million at least. Even then, you're kind of like being like, hey, what's up? So you can offer FLDG. You can put in collateral if you're really, really.
Can you elaborate on the acronym?
So FLDG is like first loss default guarantee, right? So you can be like, you can give risk participation to the bank because the point is the banks don't want to go in because we're going to get losses. Okay, fine, we'll take the losses. We're the ones who are confident about our portfolio. So hey, we'll take the losses. Still the credit team, most probably in most banks, because actually what happens in the banks inside is that the credit teams in the banks are driven by making sure that their KPIs is that to make sure the NPLs are low. But the revenue team, right, theirs is to disperse the loans. So they're very diverging incentives. So the risk team is not incentivized to generally increase the loan book. Why would they if it's going to increase their losses? So you have to. So that it's more like a there's a little bit of bureaucracy that goes into it as well. So I think FLDG is a good idea. You can launch in EduFy, we're trying to launch an education bond now, Pakistan's first education bond after you've gotten an initial loan book. You can partner with NBFCs who are liquid, right? Also give risk participation.
Abhi did a sukuk as well. But that's how.
Yeah, Abhi did as a cook. So there's always a way if you want. So yeah.
Omer, now how did you crack Mizan Bank? Because I got like my WhatsApp blew up with every founder asking me, so who in Pindi called Mizan? I'm just kidding. But how did you fill this out?
So before I answer that, I just for the rest of the audience and for all of these people on the floor, see, there are certain things that you need to know about the flow of liquidity. Faisal, you talk about this on your podcast as well, but you need to understand how the money flows through right from the top, where it gets printed, how State Bank sits on it, how it gets transmitted to the banks, what are the allocations. When you start understanding that flow, then you can potentially, step by step, the way they explained it, have access to that. Now, a lot of people don't know this. There is subsidized financing available with the State Bank of Pakistan, funded by the government of Pakistan, for women-led financing, for agriculture, for MSME, for green, at 5% or 9%.
Yeah, but I mean, even I didn't know about this. So
That's what I'm saying. And all of these things are given risk participation or stop losses by the government of Pakistan at 10%, 20%, 30%, and then sometimes, like back in 2021, 40, 50, 60%. You just have to know these things, and you have to be part of the ecosystem within the banking infrastructure to be able to tap into these reservoirs. So that's the first thing.
But how? I mean, just to be the devil's advocate.
And then,
I mean, do I have to Google this stuff, or do I? I mean, how do I?
on State Bank's website, and if you know,
So basically, you all have to go to the State Bank website.
and if you know enough bankers, they will tell you that these are the facilities. And quite frankly, even the bankers aren't using this enough.
But there are strings attached to this, right? You have to be a small business. Your turnover cannot be more than 10 crore rupees.
No, so let me answer that too. An MSME, if its annual turnover is 750 million rupees, is eligible for that facility. And right now, the cabinet is now changing that to 2 billion rupees. It's just pending. I think Prime Minister was involved. The Prime Minister has to approve it, and then it'll be 2 billion rupees. And then you get a facility for MSME, the subsidized rate for MSMEs. And not only that, you get a 20% stop loss as well. First loss as well. So, first of all, education. You need to know these things. You have to have access to this information. Number one. Number two, I think they've also answered this, that you have to back your model. So what Aleena has already explained is that you have to offer some form of risk participation, that if there is a loss and I believe that my algo will not fail and the NPLs will be low, then you have raised enough equity, back it up and tell them that I'll take the first loss. Eventually, when the bank starts seeing that there weren't enough losses, they want the margin and they'll say that we would like to participate in a fuller way. So you could have then off-balance sheet or co-financing as well. There are enough organizations within Pakistan, within GOP, or NBFCs, or even the DFIs who would be able to back your risk if you price it in. So those are some of the things.
Just to elaborate, I mean, look, you've done it in a B2B is relatively safe, right? But others, just elaborate on how do you price in that risk, right?
So I'm sure I'm not giving a general answer for the rest of the community, but in our specific case, obviously we're operating in a safer territory. We don't finance anyone who doesn't use our payments platform. You just don't do it. It's not a walk-in. You can't invite yourself into the platform. We invite you in if you're already on our payments and invoicing. So we know that there is genuine data that we actually move ourselves. Like I said, you can't lie about your payments because we debited it and we credited it. So we know you actually did it. We know your revenue, we know your cost of goods sold, we know your margins. Therefore, we can take that data to the bank and the bank relies on it because that's what the bank needs. If it's an Islamic bank,
So it's more data, basically.
so it's data driven, and then the Islamic structuring becomes very easy because the underlying asset becomes available because of the invoice data that you sit on. So those are some of the things that helped us in structuring this with an Islamic bank.
So I'll move on to another question. One of the most important, obviously, artificial intelligence is a hot topic, but ultimately, we're all going to have credit scoring engines internally in-house, right, to be a competitive fintech. Arif, I'll start with you. I mean, what is your I mean, I get it. Today we have to be in a very manual format, but given how fast everything is moving in this new realm, I think even borders become questionable when people regulators in Pakistan are feeding data into ChatGPT, right, and making the underlying LLM strong. So, what is your plan of action to develop that credit?
No, we still use everyone. Like I said, we've been going with machine learning for even before Kiss Bazaar was born. So the data that we have from the past, the areas where you've given product where there's no problem, the particular streets, the particular profession of people. So we've been taking all that down, and the machine analyzes it, and 40% or 45% of our sales are algo-based sales, and that number is increasing. But by my point,
How are the NPLs there when you do it from the algo? Is there like a secondary check on top of that, or
yeah, so just algo based will definitely have a much higher NPL still, unless it's a repeat customer. If it's a repeat customer, the model, then there is no problem at all. The same person buying a second product. But if it's a new customer, then there is a physical touch to it. The end, there is some sort of physical touch. Maybe that's a little bit of trade secret what we do, but there is a physical touch to it. And I've seen other companies in Pakistan, even before us and with us, who've tried to not do that, and NPLs have actually skyrocketed. So we do machine learning, we do feed in a lot of information, and the machine analyzes it and then gives us an opinion. And based on that opinion, we make our opinion.
Sorry, yeah.
same? And then Omer and Aleena after.
Yeah, so for us as well, so we've actually built a digital credit risk assessment system, and it's all based on data, right? And because we're integrated on the checkout and it's e-commerce merchants, it's all digital data. So you can't fudge that data. So based on that, and we have a complete view of what's going on with their e-commerce sales. A singular courier will only get the data of what they're delivering. So we get a complete view of, X merchant. This is what they're doing with courier A, courier B, courier C. This is the actual revenue. These are the actual cancellations. So basically just...
Fatin, how are you getting their actual revenue? Are you integrated with their Shopify?
Yes, so we're integrated on the checkout, on the shop, like whether Shopify, Magento, WooCommerce, custom APIs for custom platforms. So yeah, so just based on that, and we so far, I mean, volumes also makes a difference, but we have 0 NPLs because of the digital data we have access to.
Yes. Omer?
I think we have access to the same data, meaning we take it from sales channel. Can be Shopify, Magento, WooCommerce, whichever sales channel they're using. And the second part is how you look at the data, how you analyze the data. Normally, what we have seen is that you look at a business and you look at their revenue, you look at their sales, and then you jump to a point like you can see the fulfillment ratio, return ratios, and then you can decide how much you want to finance them. But we go one step ahead by even risk profiling the products as well. So what kind of products is selling, who they're selling to, demographically, geographically, because each product have a different consumer behavior. If you're selling t-shirts as compared to shoes, they both come under fashion category, but the consumer behavior is going to be different, meaning that the success ratio is going to be different for that e-commerce platform. And what percentage of your total sales are coming from each or specific kind of a product. And then there are seasonalities, meaning that if you're selling sweaters in, you can say, July, your sales are going to be very high. Yeah. And then when you underwrite the boarding, so I think they're buying it on sale in winter, no? There's not a lot of feedback. Yeah. And then if you look at the same business, you in March, or like in July. So if you look at the same business in March, you can see very high sales, but you don't expect that business to be paying back any loans that you give them in next 3 months. So there are different data points that we look at, and there are different ways of analyzing it. So the quality of the data and the quality of the revenue, and then it needs to be third-party authenticated data, which is in our case, in e-commerce, is basically sales channel.
Can you give flavor on, so that another, like for one thing is like in Daraz initially, like people, like sellers would package rocks and send it, right? So, and initially, right? So like, how do you mitigate for something like that, especially when you're like giving them 70% of that value up front to the merchant? Have you put in, I mean, those type of things exist only in Pakistan or countries like Pakistan.
Yeah, so that comes under segmentation of the businesses, or you can you can even do the segmentation of the customers as well. So we're going one step ahead, that we are even risk profiling the consumers now. We're making their profiles to understand what kind of customer base they have. And then you can do the same thing with the merchants. What kind of products is it selling? What are the success ratios? So this kind of a business where
Success ratios in terms of delivery
in delivery, yeah. So it's not about what they're dispatching, it's about what's actually being delivered, meaning that is their actual revenue. The number of sales that they're getting on their platform is not really their revenue until it's converted into a sale, meaning that once it's delivered. And in our case,
share a point as well.
Thank you. And in our case, it can be us, it can be any other third party that is delivering it. So there are two checks on it. One is coming from their sales channel, which is Shopify. And the second is if it's being fulfilled or not. If you look at businesses which are selling online on Instagram or WhatsApp. So in that case, we don't have that authentication. I mean, it can be any order that they're dispatching, and we don't even know if it's delivered or not because we don't have access to data of other logistics players. So in that case, we don't do the financing for those businesses until they build the credit with us, until they build that history with us for 3 months to 6 months. Only then
What if you use the packages to make sure there's no rocks? So like how?
No, we can't. You guys
That's
check.
confidence.
So we only find out when they go to Facebook or LinkedIn and start complaining about it.
Just so you're
Yeah, so like you said, in Pakistan, you have merchants putting rocks in their packages, right? So that's on the merchant side. Then you have customers, they're just people sitting there placing fake orders for God knows what reason. And there's a very large percentage of that, especially during sales season. What pleasure they get out of it, we don't understand, but it happens, right?
So what do they do? Just reject it?
They just reject it. They'll just block your inventory and they'll just place like 200 fake orders. So you have to start blacklisting.
Are you sure that's not Omer doing that? Do you guys?
So do you right? So you have to start blacklisting customers as well. Then there's another layer on top of that, the riders, right? So even if the merchant is sending the correct product, riders in the middle will switch the products out. So there's a lot.
That's right. Yeah.
So that happens.
That's
So on that level, we had to start blacklisting riders, not couriers, right? Because different riders work for different courier companies and they keep changing. And what we started realizing was that connected to their phone numbers, it was the same riders that were being problematic. So then we had to start blacklisting those riders and informing the courier companies that this is what's happening there.
That's cool.
So this was happening on all levels, merchant, rider, and then even from the customer side. So yeah.
And in your case, your riders are in-house.
Yeah.
So, but I'm sure you still have some fraud here and there with riders also, right? Even the employees.
Yes, that's true. We do face these kind of issues because they're jumping from one place to another place. So if they're working at any competitor in logistics, and if they're fired from there, they normally come to another courier company. Can be ours, can be anybody else in the market. So, like Fatin said, that we're highlighting those, you can say, fraudulent riders, and then we don't hire them. And now we have very strict controls around who we hire. They need to get a certificate from their previous employer. They need to go to the police station and get the approval from there, and then we hire them. And then we get a
I think you guys should collaborate and actually have a blacklisted rider database that you share with all the courier companies.
So, Faisal, we are all about collaboration. Aggregation doesn't work without that. Omer doesn't like to collaborate. Maybe you can have a word with him.
I'll try, but Omer doesn't listen to anyone. He's an athlete, so it's very tough. Aleena, coming back to you, I know your credit scoring engine since I'm invested in it, EduFy. But walk me through what type of NPLs you've seen. How do you mitigate? I know there's the processes that you go through every day. Please give everyone a flavor of how you keep your NPLs low.
Yeah, sure. So I think credit scoring at its core is two pillars, right? Which is the ability to repay, which is, hey, do you have enough money? Like all the data, what does it do? It basically assesses, hey, does this guy have the financial ability or the money to pay back? And then the second part of any credit scoring engine, no matter which sector it is the willingness to repay, which means that even if I have the money, do I want to give it to you, right? So for us, ability to repay and that financial data is picked out from the bank statement. And EduFy is our credit scoring engine that does that. It takes out a score from 0 to 100. Right now, we put the minimum score of acceptance at 80. It looks at the credits and debits of the bank statement and runs the analysis. Where it becomes interesting is EduFy's own in-house credit scoring model, which is the willingness to repay part. And actually, that is much more difficult to model. And
What do you mean by willingness to pay?
willingness to repay means, for example, if a student's GPA drops below 2.0 in a university, even if it's the richest parent ever, they're not going to pay. They're not going to pay us back, right? So education-related data is extremely important to capture. And that's why the banks can't do the sector without that data. And that's where our ERP come into place, because we place the ERP with the schools, giving it to them completely for free, because we get that data that's necessary for scoring.
So it's kind of like an alert system for you.
Exactly, yeah. But it's not just, it doesn't stop at the GPA. GPA is one of the really small criteria we look at. We look at, the days past due. Every single time a parent pays a school fee bill, how many days past the fee date does he delay the payment, right? So there's actually quite a lot that goes into it. But and then obviously we have our second level of recourse, which is the ERP shuts down if someone doesn't, we have that. And then we also have the third level, which is PDCs. So we actually forget
I'll
lots
have to elaborate on the acronyms.
the PDCs is post-dated checks as well. So actually for EduFy, we don't forget losses. Losses is classified in the lending industry as anything more than 360 days DPD, days past due. We don't even in EduFy have any section of our portfolio hitting more than 120 days DPD. And that's something that we're extremely proud of. Because if we wanted to grow, you can lend out $6 million tomorrow, right? You're not going to get the money back. It's it should be your losses that, investors look at. Same thing with just a side point, which is like when you're fundraising, I think one really important metric that investors look at is revenue. But I think it should actually be revenue, but also like how much have you raised? So how much have you burnt to get that revenue as a founder? Because that's the real indicator of how good of a founder am I. If I managed to get $1 million in revenue, but I only raised like $300,000, that's pretty damn good. If I got, so that's the same thing with lending businesses. Like NPLs is everything.
That's Omar. Well, but I think we have to wrap up. So I'd love to get your take, since I know you've got early warning systems and lots of things in place. So again, if you could elaborate on how you address these problems.
So because we're not in consumer space, most of the risk profiling is a very traditional banking process. Our data feeds into what the bank has to look at because it's all off balance sheet. So it's basically the bank that decides, having now 8 banks that are able to finance through the platform. They have their own risk criteria, which fall under state bank prudential regulation. So there are certain things that you can be innovative about and optimize and digitize, but there's some certain things that you just can't avoid. For instance, the one visit rule, which you have to visit it, physically inspect that place before you onboard them. There's anti-money laundering, KYC, all of that. So that part is largely the system enables the bank to look at our data so that they can make their own risk assessment. But so, sorry,
I want to. Others, when they've tried to do this, right? I remember you had this with another bank once where you tried to get a bank line and they wanted to go and basically open up every customer of yours and literally do a whole credit committee and analysis on it. How do you mitigate that part? Where basically they're not redoing the entire work you've done.
So it's program-based lending. So the program once has to be onboarded. So let's say it's a 5 billion rupee facility for a large cement manufacturer. Then it's that one-time activity that'll take 3 to 4 weeks where you get the program enlisted. Once it's on our platform, then the transaction is instant. It's within 10 seconds. But that one-time diligence, money laundering, KYC, terror financing, all of those checks, you have to do it. That's the law. You just can't avoid those things. Number one. And also, it's a mitigant for you as well, right? That's why the NPLs are low, because you've done that diligence. Number one. Number two, but what we launched was, we felt that within the corporate MSME space, the issue was not credit scoring, because that's a very well-established way of looking at businesses. We know what we have to look at. We have to look at inventory levels. We have to look at cost of goods sold. We have to look at margins, seasonalities, revenue, tax performance. All of those things are fairly simple to figure out. The real issue was, is he going to default? And that's what we launched last year, which is Due's default early warning system, where we were picking up payment traffic, invoice data, seasonality, regional sort of district level comparisons to predict a default. And alhamdulillah, last year, we flagged almost 4 MSMEs that we felt were about to default. Because of those early interception, those defaults did not happen. One of the guys was about to run away to Dubai. So then you can take whatever sort of kinetic action that get the law enforcement involved, just to make sure that they don't run away with the money. Because I'll give an example. If a distributor or a supplier has low inventory levels, has an aging that's gone way past the standard, and using his own equity, he's not buying a lot of product. So we have to maintain debt to equity as well, that he's putting in his own money as well, but he's also borrowing from the bank. If all those ratios are out, the system automatically detects that there's something wrong over here. That's when you make an interception and make sure that there's a recovery process initiated over there. So that's the kind of capability that we focused on, to sit on this data. The real benefit is not dispersing. The real strength is administrating credit. Credit governance is a bigger problem than what she said, that credit governance is a bigger problem compared to credit disbursement.
Yeah, and I think in your case, the quantum of the size of the disbursements are so massive that it's worth it to go through the pain. I think for a lot of the other guys where you're lending to an individual or a small merchant, it's really not worth it to go through the pain with any of the big banks, because they're really, you won't be able to lend anything. You'll be constantly onboarding people. I think we're out of time, so I'm going to cut it short right there. I don't think we have time for Q&A, but thank you, everyone. This was very helpful for me as well as an investor. Thank you.